Hey guys, Doug the Retirement Guy. We got an update on the Omaha VistaShares Target 15 Berkshire Select Income ETF. Yes, that's a lot to say. We haven't talked about Omaha in a while. We wanted to show and get back into it because it's kind of one of these things that we found to be a very stable ETF that a lot of people are starting to like and getting great performance out of it. So we're going to talk about some updates, changes, performance, buy, sell, or hold, and we'll get to that in just a second. First, I got to throw a shout out to all of our Patreon supporters. Thank you so much. You guys are wonderful, and you're keeping this channel alive and keep this channel afloat. For all the 21,000 plus subscribers, welcome to the community. Welcome back. Anyone new, boy, we'd love to have you. We're just continuously growing, trying to get you so we can grow your pocketbook. So at that point, let's get to today's video. Notice to all viewers, past performance does not guarantee future results. The information provided in the video is educational and informational purposes only. It should not be considered financial or investment advice. The examples and suggestions discussed are illustrative and may not be suitable for individual situations. Always consult a licensed financial advisor or professional for making financial decisions. So who is Omaha? Well, virtually, guys, this comes from VistaShares Target 15, the Berkshire Select Income ETF. That's the actual name of it all. Omaha basically came out when really trying to do something with the Berkshire Hathaway, saying, hey, we want to copy what they're doing. We want to give you performance, but we want you to create income from what they're doing. As we know, the Berkshire does not issue really much of a dividend. It doesn't really pay much. So it really gives us an opportunity to generate profits from what's going on. When this first come out, Omaha seeks to deliver a 15% annual income distributed monthly through covered call strategy on a portfolio mirroring the Berkshire Hathaway top holdings. When I first saw this, I was ecstatic that we have a fund that's coming out and saying we are going to give you 15%, annually. And it was at the time when I was looking at dividends and looking at financials and say, I need to put money somewhere. Where do I want to put it? And I was really pleased with 15% annual. You can do so much, and you can pretty much set it and forget it. Now, it did not take off as quickly as a lot of people thought. There was a lot of first initial investment and then stopped, and then slowly it's been picking up pace a little bit. So I wanted to get a little more updates on what's going on with it. But I was really sold right from the beginning. And even myself, I don't know if it was a set and forget and got boring. I actually walked away from a little bit just because the weeklies were been so much more fun. But the performance snapshot of Omaha's primary appeal is that monthly income through its covered calls, especially in the flat and down markets. The emphasis income generation over capital appreciation, and note that the fund remains flat since inception, with the income offsetting the slight losses. So again, this is right there, and it's done everything that it's asked it to be, and that is the market it's been in the flat and down markets that we've seen lately. This thing still cranks out its 15% on a regular basis. And we have had to take some of the dividend to offset the slight downsets. So doing exactly what they set up to do, everything that they talked about all the way through. This came out in March of 2025. And the forecast is the one that got me rolling now again, is a 3-month forecast for Omaha. It's projected as a strong buy. The consensus on the technical indicators, moving averages. So basically is what the price is going, how it's going in 5 days, the 10-day, the 20-day, and the 100-day windows are all signaling buy. It just shows that it's going to have a slow creep forward. There's a 90% confidence range that the projected near-term future will be that $19.16 to $20.01 over the next 3 months. That reflects a sideways trend. So what that means is, it's going to fall between that $19 and $20 price range over the next 3 months. So we're not going to have huge growth, but we're going to consistently get the solid 15% annually, probably a consistent 24 cents per month. just a regular flow every single month. So this is really one of the it's a cash cow type atmosphere that you're getting at 24 cents each and every month. So we don't see anything different changing here. And then the technical favor upside through the moves is limited to the 1940 and 1950 corridor. Again, everyone continues to say that this thing is going to fall in that $19 to $20 range. And we don't have to worry about the, much, I'll call, everyone else calls it NAV erosion. We don't have to worry about that part. We just know that the price is going to be right around this price point on a regular basis. So this is why they're saying buy in that 19, basically 1916 to $220, because everything shows it'll be 1940 to 1950 is where it's going to play at the whole time. We take a look at the holdings that Omaha has, and of course, the 10% is the Berkshire Hathaway and corporate. But then they get into Apple, American Express, Bank of America, VeriSign, Chevron, Coca-Cola, Visa, all the things that you hear if you do any research on the Berkshire company, what they do. Warren Buffett, what he talks about, he's in love with Coca-Cola. He's in love with the Bank of America. He's always there to help produce things. And you've heard that they've been dropping the Apple stock. So, these guys are holding tight on their Apple. So they're really watching what they do very closely. So again, very, very solid companies that they're doing with, and they're able to trade and generate the income that we want. So we take a look at right now. I call Omaha is on a correction course. And the reason why I say that is when you take a look at this, now remember, this was out since March. So they had the big April 2nd tariff kick in to basically, I call it almost its lowest point period that the fund is handled. It's come back, it's crawled right back up, had a slight drop off in the probably August 1st range. And again, it's recovering back to where we want it to be. So 1 month, it's up 0.98, almost 1 percentage point. 6 months, it's still down 1.91%. So that's not crazy in any way, shape, or form in the markets that we've seen, how the little dips that we've had. It's been just trugging along right along. And this, again, is why I think everyone forgets about it, because it's so boring. You just said it and you forget it. So for the retirees, I think this is a great program to be involved into. If you take a look at April 8th, it was down to 17.55. August 28th, we're back up to 19.51. That's about a $2 jump in just those few short months. So it's really been one of these things is you're not going to find this at a low point. You're not really going to find this to a high point. It's going very, very smooth and comfortable. The 52-week low is 1702. So that's why we look at that and say that even that April drop-off got down to 1755. Very strong numbers, holding well. Good news, bad news. If you're going to see the whole market drop, you'll see this thing drop. But again, correction and comes right back. When we take a look at the dividend, this one is so simple and easy to figure out what your dividend's going to be. You virtually take your price of the current stock. You can pretty much take that, times that by 15%, divide that by 12, and get yourself almost to a point of what you're going to get each and every month. It's that simple, and that's almost that uniform how they're doing it. And it's neat that they told us that ahead of time, so we can really watch it accordingly. So in May, you had 23, almost 24 cents. June, 23.7 cents. July was 24.5 cents. August was 24.3 cents. So we just consistently see in this dividend should be a very comfortably 24 cents per month on a regular, steady basis. So this is one, again, we always talk about set it, forget it in retirement. We just want income, income, income. This is a fund that gives you that. It gives you that 24 cents for every share that you own each and every month. Calculate out what you need to do, how do you need to handle it, and move forward. So far this year, it's at 7.46% yield. The estimate on the computer spits it out at 14.75. That's pretty much, I will call that primarily just a rounding number to where it's falling into place. So right on track of their 15 points. Return on investment, this is a big one. With the new dividend at 24.3 cents, puts the average at a solid 24 cents. So the current price today at 19.52 is going to give us 81 weeks or about a year and a half, and you'll have a full return on your investment. Now, we get this a lot on the videos. We get a lot of comments about that. Why do I worry about return on investment? What do I care about that? This is, honestly, I've had a couple of people say, this is stupid. You don't know what you're talking about. Well, it just goes to this fact. Return on investment is a very important way of investing in the market. And it's a neat way of doing it. And you'll see this more with dividend investors, that they do this on a regular basis. What we do is we will take and look at what the return on investment is, like what we have right here. This fund will take a year and a half to get all of my money back out of every share I buy in a year and a half. After that, I own the shares clean. I own them. They owes me nothing. Now I still have the shares, so I get to still collect this 15% or 24 cents every single month. I can take the money that I invested into this, and we'll just say one share at 19.52. I can take that 19.52 and now go invest it in something else and still collect my 24 cents on a regular basis and never have to worry about it. It owes me nothing. And that's a unique way of doing dividend investing, is that you buy, hold. Once it's done, you take that money out, you reinvest it somewhere else. And once you get to a big enough pot, you just sit back. Everything's been paid for. You got your original investment sitting on your sideline, and now you're collecting income. So it's a unique way, and that's why we track it. Assets under management. This is another big one. Well, these guys were rocketing and doing strong, and now they're at $478 million, and it's kind of fallen steady and kind of just stayed at that point. We were hoping that this thing would continue rocketing to get to $1 billion, but that's a long road to go. It's been tough, and they have outstanding now 2.46 million shares. So I don't see them really opening up the door and opening up a lot more shares immediately until they get more of this, 478 million growth out of it. And I really believe it's from people thinking and looking at it and saying, it's lost its lost its interest. It's lost its excitement. And again, I say it myself. I've lost it. I've lost track of it. I should be pouring more money into it just to get the 15%. But overall, solid base. They have a ton of money to work with. They have tons of shares that they've put out. And around the base, Omaha is a very, very solid piece. So in our eyes, Omaha is a buy. With that 478 million in assets under management, it's a solid number. They got plenty of money to do their calls and do their investments and keep plenty of stocks shares on the shelf. The return on investment, year and a half, again, I say it, very solid number. I personally like everything under a year, but adding that half a year with what this thing does, giving you that standard income, I don't have a problem with a year and a half in this situation. We take a look at the share price, over 180 days, it's only down 1.91%. If you guys want to talk about what's the ULTY doing, what's the YMAX doing, I'm not picking on them just completely, but you see so many of these ETFs are down, 20, 30, 40, 50%. And these guys have been just cruising right along, down 1.91%. 30 days, it's up 0.98%. We do this in another month, we'll probably see the 80 days down to the same thing, down to maybe 0.91, and the 6 month back to a 1% positive. So very, very slow moving numbers in either direction. You add in a powerful 24 cent per share or a 15% annually, it's just a regular cash input. And what our forecast is, this is a long-term ETF. You're going to buy this, and this is a 100% pure buy it, set it, forget it, put it into your funds, let it roll, collect the 15%, smile, and move on, and then say, I hope to God they open up another fund that we can do it with. And you'll start seeing this more and more in our retirement funds. I think it's just a solid piece that we've kind of got busy on the desk with weeklies, and I think this is one that people really need to take another serious look at as a great piece in the corner to maybe help make up for some of the other funds that have fallen to this wayside. Guys, it's Doug the Retirement Guy. I hope you like the review that we've done on Omaha. If you like it, give us that thumbs up. Hit that bell notice that anytime that we're putting something out there, hit that subscribe button. Join the family, join the group, and give us your comments. What do you think about Omaha? Have you forgotten about it? Have you forgotten that it's really out there and paying just the standard 15%? I admittedly say I did. And also, if you can support the channel, go on, click in the description, hit that Patreon button. It doesn't hurt. You can join for free, or you can get behind the scenes for a small little donation. Guys, we'll see you next time.